Hi class, welcome to week 4. Things are really moving along quickly, but I guess that's just the nature of things when you're doing a 6-week course. This upcoming week, we're covering some fairly exciting material in my opinion. We're going to get into understanding long-lived assets on the balance sheet, some items that really take up space and size on the balance sheet, specifically property, plant, and equipment, which is covered in Chapter 10, and intangible assets, which is covered in Chapter 11. We'll also talk about how we account for the wearing out of those assets over the course of time and how that's dealt with. But when we're talking about the primary operating assets of a business, we're usually thinking about, or oftentimes we're thinking about the property, plant, and equipment. Certainly different, some businesses are different than others, and certain ones like manufacturing companies require more property, plant, and equipment to pursue and to operate their businesses than non-manufacturing companies. They're going to require more manufacturing facilities, and that manufacturing facility is considered part of property, plant, and equipment. These businesses, as you would say, are more capital intensive. They can be industries that be telecommunications, transportation, oil production and refining, and automobile manufacturing is some key examples of capital intensive businesses. On the other hand, a lot of businesses or certain businesses have a lot of their assets go up and down the elevator every day, as they say. In other words, they're people. These businesses often sell advice and know-how. They can include firms like consulting firms, law firms, accounting firms, and it doesn't mean that these firms don't have a lot of expenses. It just means that a lot of their costs relative to their overall cost structure are variable as opposed to fixed costs that are oftentimes the case when you have a capital intensive businesses. Because their costs be more variable, sometimes it's easier to reduce those costs by laying off employees than it is sometimes to reduce those fixed costs. Hi, I thought I'd show you a little look at a comparison between a few different companies. One is a manufacturing company, General Motors, and then we have two technology companies, Facebook and Google. If you take a look here, I just gave some numbers here. We have assets, liabilities, and equities. Remember, liabilities plus equities equal assets. And so for GM, $212 billion worth of assets, 177 billion of that is liabilities, the rest is equity. And out of that $212 billion worth of assets, 36 billion are property, plant, and equipment. Same calculations for Facebook and Google, $84 billion worth of assets. And then we have 14 billion of that $84 billion of assets is property, plant, equipment, and then Google, $197 billion book value, 42 billion of that is property, plant, and equipment. Now, if we look at how the market is measuring these companies, it's a lot different. So the book value of the equity of this General Motors is $35 billion, but the market capitalization is the price that the market puts on their equity. It's the value of all the outstanding shares. So the market values the equity right here is a little bit more than the historical than is reflected on the book value here. They're paying 1.4 times, so it's a multiple of 1.4 times their book value. But if you look over here at these companies, Facebook and Google, the book value over here for Facebook is 74 billion, but the market cap, the market saying we're willing to pay $485 billion for that equity, for that ownership. So that's a 6.6 multiple. And then if you look at Google over here, the market capitalization is 824 billion, and that's relative to the book value equity 152 billion. That's a 5.4 multiple. So just a little comparison, so you're seeing these numbers and what different companies look like. So we'll end that part of the conversation right there. So far, when we've been purchasing things, they've been oftentimes they're expenses like the utilities expense, or for buying office supplies, pens, pencils, and items like that. We're purchasing them, so we are crediting cash to purchase them, using cash to purchase it, and then we are debiting related expense. Now, with fixed assets and with when we're buying property, plant, equipment, and other assets like that, assets that are going to last multiple years and help us pursue our business operations, that has continued value. They're not expensed. It doesn't go away quite as quickly. So we capitalize it. it's added to the balance sheet. If we're paying cash, we're crediting cash, we're reducing that asset, and then we're going to debit the related property, plant, and equipment. But it also makes sense that the property is going to be worn out a little bit each year. If we buy a manufacturing facility to make cars, it's not going to last forever. So we have to account for that wearing out a little bit each year. And there are different schedules, depreciation schedules, that we're allowed to use to depreciate these items. And for now, we'll give some examples here. The book may tell you how long lived the estimated future life of an asset, and then we may depreciate it accordingly, or we may use the typical schedules that are created for each different asset class. Has different schedules to depreciate it. For example, if we're talking about residential real estate, generally we're going to depreciate that over the course of 27.5 years. And if we're talking about commercial real estate, we're going to do it 39 years. Now, there are different types. Sometimes we can depreciate it more quickly, and the text will get into that. Sometimes there's accelerated depreciation, where some of the assets we can depreciate more quickly than others. But just get the idea that depreciation is what we use to account for the wearing out of those assets every year. Also, when we're doing the journal entries to account for depreciation, what we're going to be doing is we will debit a depreciation expense account, and at the same time we're kind of crediting the asset, because we're going to reflect that the asset's being reduced in value every year. However, we're not directly crediting the asset. There's going to be an account that goes along with that asset account. It's called a contra asset account in this case, and it's specifically the name of the one we're talking about in this scenario is called accumulated depreciation. So that accumulated depreciation account is going to be associated with the asset that is being depreciated. And so each year we're going to credit that accumulated depreciation account. And the sum of that, all the different amounts that we've credited to the accumulated depreciation, will be the sum of the depreciation that we've depreciated over the course of the years. And when this is difficult, you're going to see it in your books, but when the amount of accumulated depreciation equals so when the credit balance of the accumulated depreciation equals the debit balance of that asset, then there's going to be no net value to that asset. So it's going to be totally depreciated, and we'll remove those accounts from the balance sheet. A little bit complicated. Read through the text, look at the different examples they have, but I hope that is a decent introduction to the subject. Okay, this video is getting a little long, so I will try to deal with intangible assets as quickly as I can. A little introduction to intangible assets. Intangible assets include things like you'll see on the screen, copy from your text here, include things copyrights, patents, trademarks, customer information. Data is becoming more valuable than ever. Goodwill. For companies that create these assets, they don't show up on the balance sheet and they don't have any book value. That's because the company didn't purchase them. Assets on the balance sheet, the book value and the assets on the balance sheet, it's reflected based on how much you paid for something at a point in time in history. In other words, historical cost less the depreciation over the course of time. Market value is an entirely different thing. So these intangible assets show up on the balance sheet when a company purchases or acquires those intangible assets from another company or from the owner of those intangible assets. If a company purchases a patent from another company, that patent shows up on the balance sheet because they paid for it. Also, when a company acquires another company and pays more for the company than the company's book value, that excess amount is recorded on the balance sheet as goodwill. The final thing we're going to do today is talk about how to account for the loss in value in intangible assets. Obviously, those intangible assets we talked about, patents, trademarks, copyrights, they're not going to have value that lasts indefinitely, so we have to account for the reduction in their value in the same way that we accounted for the reduction in the value of tangible assets over the course of time by using depreciation. The same sort of thing happens with these intangible assets, but instead of calling it depreciation, we call it amortization. And you see here an example of a journal entry that that reflects that amortization expense. We're debiting the amortization expense and crediting the asset there, the copyright. Goodwill differs from the other intangible assets that we talked about recently, like patents and trademarks and copyrights and so forth. Goodwill happens when one company purchases another company for more than its book value. That excess amount shows up on the balance sheet as goodwill. If you look right here at Bank of America's balance sheet, you'll see that one, they have a massive balance sheet at $2.3 trillion of assets almost, and about $69 billion there of goodwill. Goodwill is there, total assets here, so almost $69 billion worth of goodwill. And goodwill isn't amortized in the same way that the other intangible assets are. However, if it has been determined that the value of the goodwill exceeds its fair value, when it can be assessed for impairment. So that's the difference. So it's assessed for impairment, and we'll look at exactly what that entails in your book. So it's not amortized in that sense. And if you're looking, see, this is that same financial report that I was showing you before. Here's one page, and then this page actually tells you a little bit. It says this is actually on Bank of America's financial report. In the notes, it says goodwill is not amortized, but it is reviewed for potential impairment on an annual basis, or when events or circumstances indicate a potential impairment at the reporting unit level. So you can actually see some of the stuff in the notes. I hope this has been helpful. There's a lot of new material. It's kind of exciting, and you're getting more and more of an understanding of accounting. All right, good luck this week, and if you have any questions, of course, reach out to me. All right, we'll talk to you next time.